For years, the debate over tariffs has sounded almost familiar. Higher prices, trade wars, winners and losers. But that conversation misses the real story, because the most dangerous cost of protectionism doesn't show up on store shelves. It shows up somewhere far quieter, in the bond market that holds the entire US economy together. I want you to imagine this for a moment. Every mortgage payment, every car loan, every business expansion, all of it quietly anchored to one number most people never watch: the yield on US Treasury bonds. Now here's the uncomfortable question. What happens when trade policy designed to protect starts destabilizing the very market that funds the government itself? Tariffs are raising revenue, yes, but they're also reshaping debt, demand, and confidence in ways few are talking about. If this sounds abstract, stay with me, because what happens next won't stay on Wall Street. And if you value clear system-level explanations like this, make sure you're following along. To understand why this matters so much, we need to step back and define the real problem hiding underneath the headlines. At the surface, the argument for tariffs feels straightforward. Raise duties, protect domestic industries, collect more revenue. In a world of rising deficits, that sounds almost responsible. But the real issue isn't whether tariffs bring in money. It's where that money fits inside a much larger system, one already under strain. The United States is running budget deficits near historic highs. Not because of a crisis, but as a baseline. That means the government must constantly borrow. And borrowing at this scale depends on one thing above all else: a steady, confident market for US Treasury bonds. Here's where trade policy quietly enters the picture. Tariffs don't just affect prices or supply chains. They influence how many bonds the government needs to issue, how investors perceive risk, and how sensitive the system becomes to policy shocks. In other words, tariffs don't sit on the edge of the economy. They run straight through its financial core. When trade policy becomes volatile, the Treasury market absorbs that volatility first, long before households or voters notice. And once confidence in that market starts to wobble, the consequences spread fast. To see how we got here, we need to look backward at the fiscal path that made this system so fragile in the first place. To understand why today's trade decisions carry so much weight, we need to rewind not decades, but patterns. For most of modern US history, large budget deficits were the exception. They appeared during wars, recessions, or emergencies. Then they faded. That cycle has quietly broken long before tariffs returned to center stage. The federal government normalized borrowing at scale. Spending commitments grew faster than revenues, and debt issuance became routine rather than reactive. This matters because Treasury bonds are not just financing tools. They are promises to investors, to households, to the global system. When deficits expand, bond supply must expand with them. And that works only if demand keeps pace. Trade policy enters here not as a headline issue, but as a structural modifier. Tariffs can temporarily reduce how much debt needs to be issued, but they do so inside a system already stretched thin. The danger isn't the tariff itself. It's the assumption that short-term revenue fixes can stabilize a long-term fiscal trajectory. Once markets sense that borrowing is structural, not cyclical, they begin pricing risk differently. And that shift, slow, technical, almost invisible, is what sets the stage for sudden moments of crisis. The first of those moments didn't come from trade alone, but trade helped light the fuse. The warning shot came quietly, but the market heard it. In the middle of 2023, the US Treasury did something routine. It announced it would need to issue more debt than expected. No crisis, no recession, just math catching up with policy. The reaction was immediate. Bond investors demanded higher compensation. The term premium on the 10-year Treasury jumped. Yields surged toward levels not seen in years. And then came the signal that rattled confidence further. A downgrade of U.S. government credit. Equities slid. Borrowing costs rose. Suddenly, what looked like a technical adjustment felt like a system under stress. This moment mattered because it revealed something uncomfortable. The Treasury market is no longer insulated from surprises. It is sensitive, reactive, and increasingly dependent on expectations, staying perfectly aligned. Tariffs didn't cause that episode, but they exist inside the same fragile environment, one where revenue assumptions, legal challenges, and future policy shifts can force investors to reprice risk quickly. When markets have to constantly recalibrate how much debt is coming and who will buy it, stability becomes conditional. And once stability becomes conditional, volatility is never far behind. That was only the first crack. The deeper vulnerability lies not in how much debt is issued, but in who is still willing to hold it. On paper, the Treasury market looks unshakable. Trillions of dollars, deep liquidity, global trust built over decades. But underneath that scale sits a quieter shift. The buyer base is changing. For years, the system relied on a dependable trio: the Federal Reserve, U.S. banks, and foreign governments. They weren't chasing yield. They were anchoring stability. That anchor is lighter now. The Federal Reserve is no longer absorbing debt at crisis-era levels. Banks face balance sheet limits and regulatory constraints. And foreign buyers still present are no longer expanding exposure the way they once did. Here's where tariffs quietly distort the picture. Trade policy shapes global relationships, and global relationships shape reserve behavior. When countries trade heavily with the United States, holding dollar assets makes sense. When trade fragments, diversification follows slowly, politely, and off-stage. No press releases, no dramatic sell-offs, just bonds maturing and fewer being replaced. At the same time, policymakers are searching for new demand, short-term instruments, alternative buyers, even technological substitutes that promise stability. The system still works, but it works with less margin for error. And when demand becomes conditional on growth, on policy credibility, on inflation staying tame, the bond market stops being a passive backdrop. It becomes an active judge, and that judgment is felt first in yields. The second shock doesn't arrive as a headline event. It arrives as a convergence. Tariffs push prices higher. Growth expectations soften. Deficits widen again as spending commitments collide with political reality. Markets don't panic all at once. They adjust. In the days after major tariff announcements, bond yields moved faster than policymakers expected, not because investors feared recession, but because inflation stopped looking temporary. That combination is toxic for bonds. Sticky inflation means the Federal Reserve has less room to cut. Less Fed support means investors demand higher compensation. And higher compensation means higher long-term yields. This is where the system tightens. Short-term borrowing becomes riskier. Refinancing gets more expensive. Volatility migrates from trade headlines into financial plumbing. Even small surprises start to matter more. A debt ceiling standoff, a legal ruling on tariff authority, a downgrade threat resurfacing. None of these break the system alone, but together they compress the margin for error. The Treasury market can absorb shocks, but only when growth, inflation, and policy credibility pull in the same direction. When they don't, yields rise not out of fear, but out of recalibration. And that recalibration doesn't stay in bond markets. It moves outward, straight toward households. This is where the story gets personal. Every person watching this knows what it's like to feel the weight of rising costs. But what if it's more than just gas prices and grocery bills? What if the real cost of protectionism isn't just inflation, but the burden it places on your mortgage, your car loan, your savings? As tariffs climb, so does the cost of credit. Those monthly payments that seem small now, they get heavier when yields rise and borrowing costs follow. Imagine the next generation inheriting higher bills, slower economic growth, and fewer opportunities. This is where trade policy becomes more than a Wall Street issue. It becomes a question of quality of life, and that is where the people of this country feel the impact most. The president, the Treasury Secretary, they aren't the ones who face the bill. It's you. But here's the truth. You don't have to accept this. The decisions made today about tariffs, about fiscal policy, they directly shape your future. What happens next depends on whether we take control of this trajectory before it controls us. Stay tuned. The next chapter matters more than you think. What happens next isn't confined to the borders of the United States. The world watches, and in many ways, it follows. Trade policy reverberates beyond our shores, to markets, to currencies, to global growth. As US tariffs rise, the world adjusts. Foreign nations diversify their reserves, shifting away from the dollar, even slowly, as a hedge. But this isn't just an issue of foreign investment leaving. It's a global interconnection where every decision sends ripples. When the US Treasury yields climb, so do borrowing costs worldwide. Other countries borrow in dollars, so US yield spikes create a higher cost of credit across the global economy. What happens when other nations start questioning the long-term viability of holding dollar-denominated debt? What happens when trade tensions escalate and the reliance on US bonds shrinks? This isn't just an American issue anymore. It's a global one. The balance of power, the strength of economies, the flow of capital all depend on the United States' ability to keep its financial system trusted. And as tariffs raise the stakes, the future of the global economy is at risk. The question is whether we're ready to manage that risk or whether the system will manage us. Let's look ahead. The future of US trade policy could take three very different paths. Each one comes with its own set of consequences for the Treasury market and, by extension, your financial world. The best case scenario, tariffs start to ease. The US makes targeted moves to reduce inflationary pressures, focuses on key strategic industries, and works towards fiscal responsibility. The Treasury market stabilizes. Bond yields moderate. Investor confidence returns with a smooth path for deficit financing. Inflation stays in check, and the Federal Reserve is able to bring rates down, reducing the strain on businesses and households. The US economy grows at a stable rate, and the global market finds confidence in the dollar once again. The middle ground, a slow easing of tariffs. The government continues its fiscal spending, but with minor adjustments. Treasuries see moderate volatility, and yields remain high for longer, forcing the Federal Reserve into a delicate balancing act. The global system remains uneasy, foreign demand for treasuries remains weak, and new buyers like stablecoins don't fill the gap entirely. This path keeps the US economy growing, but at a much slower pace. The impact on households isn't immediate, but it's real. The worst case scenario, tariffs escalate further. The global trade order shifts. Foreign governments pull back from US treasuries. Inflation remains sticky, and the deficit continues to climb. In this scenario, the US faces an even harder time financing its debt. Higher yields spike across the yield curve. Market liquidity tightens. The global economy braces for a downturn as investor confidence falters. This is the scenario policymakers must avoid, the one where short-term fixes lead to long-term pain. The future isn't set, but the decisions we make now will determine which path we walk. The truth is, we stand at a crossroads. The decisions made today about trade, tariffs, and fiscal policy are not just about economic balance, they are about our future stability. If we act wisely, adjusting tariffs, embracing strategic flexibility, and committing to long-term fiscal responsibility, the U.S. Treasury market could maintain its crucial position at the heart of global finance. Bond yields could stabilize, making it easier for businesses to grow, for families to borrow, and for the government to sustain its obligations. But if we don't, the risks are clear: higher yields, volatile markets, and a future where the cost of borrowing weighs on every American's future. This is not an abstract issue. It's a very real question about the direction we want to go in. It's about whether we can control our fiscal future or if it will control us. So here's the question we all need to answer. What kind of future do we want? If we want stability, if we want growth, if we want a future where every American can thrive, the time to act is now. The next steps we take could shape the next decade, and the stakes couldn't be higher.